Hey guys, thank you so much for joining. My name is Prashant Kumar. Along with me, I have today my great friend Stefan. We are going to talk. We have a very interesting topic today. We're going to talk about it and everything. But before that, let me just introduce myself also a little bit, and then I will introduce Stefan. I know Stefan for I think maybe for last 6 months or so, and we have been talking constantly. And I asked him to come to my webinar, because what he does is really impressive, very impressive to me. So just a little bit about myself. I am the president of company, My Realty Gains. I recently launched a website, myrealtygains.com. Besides that, I have another website called Multi-Family Realty Gains. So My Realty Gains and Multi-Family Realty Gains. My Realty Gains is more of an educational website for attracting passive investors, and Multi-Family Realty Gains is what I really do, is multifamily syndication, right? So whatever you are going to listen today, this is primarily only for the educational purposes, and nothing that we talk about should be taken as it is. You should consult your investment advisors. But a little bit about myself, I have very strong technology background for last 25 years. I'm into technology and management sector, managing projects all over the world. I own, in my personal portfolio, I own about 100 units, and I do syndication also. Last year we did about 1,200 units. And for obvious reasons, this year we have not done much. We are in few projects right now in the contract, and we'll explain that later. But my basic competencies to improve redundancies in the process and meticulously underwriting the deals. In addition to multifamily, I do assisted living also. Our group does assisted living as well. And last year we invested into assisted livings, and this year also we are working on acquiring few properties in assisted living area. I'm always out there willing to mentor and share the knowledge via meetups and through social media interactions. If I can help anybody, I would love to help. And I plan to continue to do more syndications in multifamily and in assisted living space also. That is something that I've been exploring, bought some assets, but I have yet to do the syndication in assisted living. So my email address is simple, Prashant at My Realty Gains. My phone number is 631-428-6479. That is just a little bit about myself, okay? But now I don't want to steal the thunder from you guys. I've invited my friend Stefan with me today. Stefan is a financial engineer and he's a real estate investor in multifamily space across, and he has done various strategies. He owned 3 and 4 unit properties in New Jersey and a duplex in upstate New York. He's the founder of Envvy Analytics, an investor-geared. Envvy Analytics is an investor-geared property analytics software, and Pepela Equity Partners, a real estate investment firm, basically. So he's a founder of a bunch of these things, and he's an organizer of Finance Meets Real Estate Investor Meetup also. So today our topic is, is the real estate market overheated, right? Stefan is MS in financial engineering, and he will take data-driven approach today. He's going to discuss data-driven approach. Basically, he's going to talk about the current state of valuation in U.S. private residential real estate, valuation based on historical price, income relationship, reveal high correlations versus post-2007 actual drop levels. Whatever he's going to do, I know he's going to do a marvelous job because I have seen what he does. So I don't want to take too much of time talking about him, and I will let him come onto the presentation and start presentation. It's just going to be marvelous, fundamental. You know, you, you'll just see. Okay, Stefan, on to you now. Okay, you can. I'm going to stop sharing, and you can start sharing. Okay.
All right. Thank you so much, Prashant. What a great introduction, really. And let me share my screen now. So as you mentioned, so current topic is the real estate market overvalued right now. So let me just, one moment. So as you mentioned, I'm a financial engineer. I trade derivatives for an insurance company, but I have been investing in real estate since 2017, and I do have a data analytics company and a real estate investment company. So in June of this year, the National Bureau of Economic Research announced a recession. So a recession meaning 2 consecutive quarters of GDP slowdown. So with that, in this lecture, I'm going to take the approach of, okay, we already have a factual recession. We don't know where we stand in the market cycle. We don't know if we're at peak. But assuming we happen to be at peak, what are some projections for the future? And then let's take a look at also, is the market overvalued right now, and how does this stand? So I did this analysis about 2 months ago initially. So this is where real estate investment trusts were at the moment. So it's roughly similar right now. So real estate investment trusts, this is specifically in the residential, multifamily residential sector. So it has no commercial, has no industrial, etc., offices, etc., component or retail, none of that. Purely residential, 23% down since, since the peak back in February. So that's something interesting. So the stock market is suggesting that multifamily real estate may drop. We are not seeing any of that. Now, private real estate valuations, they are lagging, and they tend to have a smaller drop as well. So that's what data usually shows. But still, it's interesting to see in the stock market, a pretty substantial drop is projected. I don't think it's going to be too bad though. And so here, this is just a quick chart on correlation between commercial multifamily and FHFA prices, home prices. So FHFA, that would be just like single family, small multifamily homes. So correlation is like 97%. So it's different asset classes, obviously, different appraisal approach, etc. But, it kind of washes out. So that's something to look into. As you know, like many people here may be interested in syndication. So that's something to consider, that data, okay, indirectly does have relevance to the commercial multifamily sector as well. Now, Zillow did a literature review on past pandemics. And what they showed is basically, so they looked at SARS and Spanish flu, and they showed that basically there is a quick jump back in activity after the recessions that were attributed to pandemics, versus in other recessions, there would be like a more prolonged period, such as 6 to 18 months. So that's something that they did. Now, if a drop was to happen in certain places, okay, what are some of the foreclosure states? So consistently in the last 5 years, the top 5 states are New Jersey, Delaware, Maryland, Florida, and Illinois. So those have been leading foreclosure rates in recent years.
Stefan, before we move forward, I would ask, I know you said that it has already declared in June of this year that we are in recession. Can you explain that, what is the degree of recession and how we have measured it and how we are projecting it in the next couple of months or next couple of quarters? I just want to clarify that point with our audiences very clearly, if that's okay with you.
Okay, yeah. With regards to projecting, I don't have any like economic, that's not something I do in terms of economic projections for the recession, but in terms of the June 8th announcement that they did, it is based on basically GDP growth and 2 consecutive quarters of a slowdown. So basically what they saw is that peak of economic activity occurred in February. And with 2 consecutive quarters back, that marked an expansion that actually began in 2009. So that is purely in business cycles. Recession is factual. Now, is that going to affect real estate? Not necessarily. Historically, in many recessions, real estate was perfectly flat or continued to grow, etc. So that's not necessarily going to have an impact, but it's still something to consider. Okay, it's a more special time. It's a more special time. So can we look at if we do happen to be at peak from a data standpoint, what would happen then? So these are the foreclosure states. So as we see, like very close to, like, I personally reside in New Jersey. So New Jersey #1 consistently in foreclosures for a few years. So one thing I did, like, for this study, so I started with 2007 data, and I was looking at what happened in 2007. And I used that as a model, and then I tried to, like, make some projections at the current time. So in 2007, these were the biggest drops that happened. So the biggest drops were in Nevada, Arizona, California, Florida were the big 4. There were some, big drops in also Michigan, Idaho, Oregon, etc. So it's very interesting what happened then, because, everybody knows this was like the biggest real estate crash in recorded US history, right? And yet that crash didn't happen everywhere. So that crash, for instance, did not happen in North Dakota. In North Dakota, the drop was, in fact, 0%. There was no drop at all. In South Dakota, the drop was 3%. We had a few other states of, like, okay, the states of Nebraska, Iowa, Kansas, Oklahoma, Texas at that time, that were very, very little affected. So what I did is I was just trying to understand why that happened. Like, why did Nevada drop so much and North Dakota didn't drop at all? So first I started looking at volatility. So I wanted to do volatility studies for the different states and try to understand, okay, maybe certain places are inherently more volatile. For example, maybe because of their foreclosure rates. Let's say one would expect, okay, maybe New Jersey, Delaware, Maryland, Florida, and Illinois are inherently more volatile. And so I wanted to look at that. So I did, like, price volatility studies. So this is percentage relative standard deviation by US state. So what it showed is, it showed the Western states as well as Northeast in the lead in terms of volatility. And then some very low income states like West Virginia, Mississippi, Arkansas, Alabama, Oklahoma, actually, and some states in the Midwest, West actually being the least volatile. So that was something interesting as a start. And then I did some correlation studies. So correlation is useful in the sense, if we have the primary market, the primary US market doing well, the US economy is doing well, real estate is reflecting that partially, is doing well as well. But what are some places that maybe some places don't trend with the main market?
So when you say prices, these are absolute prices, or these are price per square feet? What do you mean
these
by
are
price?
just the absolute prices. These are just median home values from, this is from Federal Reserve Bank of St. Louis at the state level. I did this study also at county level. At county level, I use FHFA, so Federal Housing Finance Agencies. And yeah, these are not per square foot. These are just like home values. And it's primarily, so it's not directly, it's not commercial multifamily because it's harder to get data on that. But, as we saw, there is a high correlation between the two. So I think it's the more predictive, still better approach. And yeah, so some places actually are not so correlated with the main market. For instance, Nevada is less correlated, only 89%, and Michigan, Illinois, relatively little. And most other places at like 98, 99%, really correlate. So that's just a small observation. And then the other thing that's actually more interesting is, if we are now not at the peak, what happens is that momentum drives real estate. So momentum, one way to study it is autocorrelation. So autocorrelation is actually, this is autocorrelation of current price growth, this year price growth versus last year price growth. So if, for example, Colorado is, like one of the best performing places in America in this cycle. So if Colorado performed well last year, with 71% correlation, it's going to perform well this year as well. So that's what this is showing. So this is showing that real estate is very driven by momentum. So that's something to consider. So even though here I'm doing an overvalued market study, and I'm going to get back to this, I'm going to get to this in a moment. But if the peak does not happen now and market continues after COVID for a few more years, it's going to be the same markets, even if they're overvalued, it's going to be the same markets that are going to perform the best. So that's something interesting. But the only place that was negatively autocorrelated was Alaska, actually. So good performance last year is actually bad performance this year, slightly, very slightly. And then in North, South Dakota, Montana, it's like insignificant, and there isn't autocorrelation. So that's something interesting. So just a quick remark in finance. As some of you know, like you can have like a stock, and that stock can be performing really well. You can have a penny stock, let's say, performing really well, and then you can have a blue chip, let's say. But one would expect, generally speaking, the stronger company to actually have a better Sharpe ratio or a better risk-adjusted return. So that is something in finance. So I did a similar study here. So which states have had the best risk-adjusted returns? So by Sharpe ratio. So it's a little bit interesting. So at the top, we're actually at the top, so we have like Kentucky, North Carolina, the state of Washington, Colorado, Kansas, California. And at the bottom are actually North Dakota, South Dakota, Nevada. So that's interesting. But I would say, is Sharpe ratio driving too much in real estate? I'm not sure, because as you will see later, volatility, so within Sharpe ratio, volatility is not a very reliable component. Volatility tends to be where in places that become overvalued at times. And so I don't think it's a super useful predictive metric, but it's still something interesting to consider. Okay, we can take different places and we can see some of them adjusted for volatility are actually performing better. And so then market performance. So here I did a study based on just this is just purely price data. So not a study, just price data since the 2007 peak. So peak occurred at different dates in different regions. These are the price performances. So best performances were from this perspective, were in Colorado and Texas, Idaho, North Dakota, Utah. And I did a further improvement on that later, and I don't have it yet actually here, but it's where actually it's more accurate to get per price performances since the last occurring fair valuation in each market.
So this chart simply means that Texas prices in Texas were improving. The performance was highest in Texas and in
since 2007 peak. Since 2007 peak, purely price performance. So those were like some of the strong markets, And so on the contrary, here it's like pretty small on the map, but let's say Northeast, it's, much weaker performances. Illinois.
North Dakota did not go down in 2007, 2009 crash, but it went up higher as compared to other states in the country.
Absolutely. And in fact, Texas that we know is like the booming place. And then, every big, big investment, like some of the biggest investment firms, invest primarily there. And that is something that Texas actually dropped only 4% back then, and yet it's the best performer because it does not have to do with that. It just has to do with, there can be different reasons for being overvalued or undervalued at that time. Mm-hmm. And I'll get to this in a second. And the weakest actually didn't get included like the detailed table here. Connecticut was the worst performer. Connecticut, New Jersey, and Delaware were the worst performers this market cycle. And so that's purely prices. Now on the cities level, just something to note, Denver, Colorado, 79% out of 800 cities since 2007 peak, 79% above its previous peak. So that's like an interesting observation. Then as we see, it's primarily cities in Colorado, Texas, there is some other strong cities, Nashville, San Francisco, Washington, and Durham, North Carolina. And at the bottom, well, yeah, at the bottom, so there, you know, like a few other places. California has performed well, but California has a huge number of cities. So I was mentioning this, I think I mentioned this at my own meetup actually, where California has like 22% of the cities in America actually. You know, are in California, like so out of 800 cities, 22% of them are in California. So it's very, there are many, a big variety of performances that happen there. So they have some super strongly performing cities and then have some, you know, poorly performing cities and that. And then, so here, just like a little bit of slightly technical introduction from finance. So John Hussman is like, he has PhD in finance, maybe. So he did like a study, he runs a hedge fund. So he tends to be a little bit bearish, okay? But his actual approach, he did like a correlation study between different valuation metrics and subsequent price performance in the stock market. And so what is the point of doing this? So basically, as you know, some of you know, in finance, like valuation, usually the most popular thing is price earnings ratios. So if you know, if is the price too high compared to the corporate earnings that underlie this price, and so that had 76% predictiveness versus subsequent returns, which is okay. It's an okay correlation, not super high. But then there are other metrics, for instance, price revenue performance better. And then he devised his own metric, non-financial market cap to corporate gross value added that actually had 91% correlation with the subsequent drops in S&P that happened. So that's something. So what I did is I tried to recreate a similar correlation studies for price income ratio, specifically in real estate. And I'm not inventing the wheel. That is a simple approach, one can say. So that was done, has been done also by you know, other researchers. So Niraj Shah had a study that was published at Visual Capitalist that was based on several metrics: house price to rent ratio, house price income ratio, real house prices, and credit of households percent of GDP. And that showed, I think, a very interesting picture. That's it in July 2019. Showed an interesting picture of which countries are actually overvalued. So the high level comment for US is not slightly overvalued to basically fairly valued. That is broadly speaking. There are certain places that we will see are overvalued, but broadly US is fairly valued. That's not the case in Canada. That's not the case in Scandinavia. Also Australia and New Zealand. And in UK, there is some overvaluement as well. So there are actually real estate markets right now that are in a bubble. So that's interesting, but it's not the US market, broadly speaking. And now in 2007, in the US market was very different. So in 2007, there was a guy, his name is Ingo Winzer. So he runs like an analysis company in Massachusetts called Local Market Monitor. So he was at the time, he was on CNN and he was on the news, and he was basically saying that US real estate market, certain cities are dangerously overvalued. So he was doing that in 2005, and then the table to the right is in 2006. So he was doing it for some time. He was able to do it without being a fortune teller of sort, because those are the metrics that he had at the time, and they were showing, you know, cities significant, you know, 50%, etc., overvalued in California and Florida, etc. So that is something similar that I did. Yeah, so in 2007, 2009, this is how real estate valuation looked. So what I do is I compute, in this study, I compute percentage deviation from historical price income ratio. So very simple. Most of the work is just to calibrate where what should be the accurate periods for the historical value, and what specific, you know, aggregate metric to use, let's say. And from there, like a correlation study of how valuations in 2007, where valuations means it's not price income ratios, it's how much the level is different from where it should be, the price income ratio level. And that correlated 83% versus the subsequent drops. So that was like super powerful, because if we look at like the table, here the top 4 overvalued places, California, Nevada, Arizona, and Florida. So as we saw back before, excuse the, those were the main drops. So California, Arizona, Nevada, and Florida. But let me look at it in more detail actually. So those values, purely the metric, and completely predictably, these are not time series that move together that are correlated 83%. This is predicting the future. This is at the peak date in every market that is different. And I did this study at county level, by the way, as well. It's a slightly less correlation there. But at the peak in each market, this is where the valuation stands. And the drops that happen over the subsequent years, where the average drop would be like 4 years and a quarter. It took a while to reach the bottom. But that drop was 83% correlated. So that is the main finding, I would say, for today. Yes, so here is like the detail table. So these were in 2007, all markets that were overvalued. Overvalued, let's say greater than 10% valuation. So they had like a median valuation of 26%, let's say, and the median price drop that happened was 22%. So that's what happened in overvalued markets. Now, what happened in fairly valued markets? 0 to 10% valuation was materially different. The median drop now was still high. It's a very big correction scenario in 2007, but was only 11%. And the most interesting thing is what happened in undervalued markets. So in undervalued markets, so negative valuation, the median drop was 4%. But this is, to me, amazing, because that means one can have continuity in the current cycle. One can continue investing his own capital, raising capital from other people as well. And if one invested in undervalued markets, even if a global correction happens, like in 2007, which was a broad correction scenario across the board, even if a global correction happens, the drop would be very small in undervalued states, at least. At the county level, there can be noise because there's all kinds of population shifts, etc. Things can happen there. But purely at the state level, it's very predictive. And yeah, and actually what is interesting is that incomes post 2007 dropped also on average, in the US by 4%. So in undervalued markets, their valuations actually, high level speaking, stayed the same. So there wasn't even a valuation drop. It was just that incomes dropped by 4%, and that's the drop that happened there. So this is, to me, like super, super useful in my own investment endeavor, and that's a primary factor that I look for right now. Now, if we're not at peak, there is a different aspect that, as we saw, momentum drives prices. So some of the overvalued markets would continue doing the best, and they would be doing, the best for a few years, and then at some point a peak will happen, and then they will correct. And that. So now, where do valuations stand currently? So I don't want to go over time. So currently we have so that data is a little bit lagging the way governmental agencies post it, actually. So this is as of Q1 2020. But prices have not really corrected thus far, broadly speaking. So as of Q1, these are where valuations stood. So it's broadly a fairly valued market. Most states are undervalued, but some places are overvalued. The places that are overvalued are some markets that actually they performed quite strong and are in a little bit overvalued territory. Idaho is the most notable overvalued market right now at 22%. From there, we have Texas, we have Arizona, we have Nevada, Arizona, Florida, Colorado. So these markets are a bit overvalued. If we don't reach a peak, if it's not the peak right now, this overvaluation means nothing. That's going to continue. It can get to 50%. It maybe can resolve. It can also disappear. But if once a peak of cycle is reached, and every market cycle at some point is going to reach its peak, those markets are going to have a bigger drop than undervalued markets. And undervalued markets, as we saw, I don't think they will have any drop at all. So these are the overvalued markets. In some of them, there was some income underperformance also that drove the overvaluation. And fairly valued markets between like 0 and 10%. So they experience like inline performance between their prices and incomes. But again, in fairly valued markets, some drop can happen as we saw. So we can have like a 10, 12% drop can happen. It's not so safe there. And as we see, actually, 30 out of 50 states are currently undervalued. So that is the state in the US economy. And this is the same metric that in 2007 showed the market super overvalued in some places. Again, not all places were overvalued then as well. And okay, so this is like a table that shows some of the undervalued markets that have had strong price performance. And here, price performance is since the previous peak. So, so one improvement that that is actually that I was working on subsequently actually is it's better to not use the previous peak, but determine get the full history of valuations and determine at which exact point each market has been fairly valued, and get the price performance only since then. But still, this is like some high level outlook of some markets where, if we take as an example Indiana, Indiana is 27% above its previous peak, and yet Indiana is still undervalued, still 6% undervalued. So this is the kind of approach, in my opinion, from a pure price perspective, to take right now. And yeah, now
Is there any state, is there any market which does not have drop projected, positive drop projected?
Well, no, no. If there is a peak in cycle, everything has a drop. Yes, so that's why we have even undervalued markets. There will be at peak of cycle usually some income drop. They will drop like 3-4%. So
okay, so like Wisconsin, we are saying 3%. Can we go back one slide and see Idaho? How much projection was that on Idaho?
Yeah. So for Idaho, it's 19%.
19%. Okay.
Yeah, and those projections actually I forgot to mention. So there, I used the regression coefficients from 2007 in terms of what were the valuations then, what were the drops that happened then. So it's kind of based on that. 2007 was a correction scenario. Everything corrected in 2007. Even undervalued markets, as we saw, they also corrected. They had their slow income drop and but that was what happened then. And so this is not something that I'm suggesting would happen now. I have no knowledge when it would happen. But again, whenever the peak happens, could be now, could be 5 years from now. This is going to be the most predictive measure for the drops at peak of cycle and subsequently. For peak of cycle, Idaho is going to be one of the best performers before peak of cycle. It will continue to have like strong momentum and etc.
So I mean, what you are saying is we really don't know whether we are at the peak right now.
We don't know, but this is exactly. But this is a study, though. If sort of a market, sort of like a market cycle kind of study. Like if once the new 2007 happens, those are it's still relevant to me. For instance, like I don't know when it's going to happen. I don't personally want to invest in Idaho now. Like it's significantly overvalued. Now, some of the other places, okay, Texas, it's one of the best markets and it's not so overvalued. That's going to continue being one of the best markets probably for some time.
Maybe just invest into undervalued market rather than overvalued market to begin with. I mean, there are a lot of markets,
Well, yeah, it's I mean, one can have an undervalued market that is a super strong performer. That is possible. And yeah, that is the approach. So yeah, at the current point, I think the approach is like this table to pick undervalued markets, but not only that they're undervalued, but also have performed well. And that is what I think.
Arkansas is 14% undervalued right now, or Wisconsin.
Yeah, Arkansas is very
percent.
overvalued. Yeah.
If they are projected to not go down that much, I mean, if you find an asset where you have extreme value add, you can still get
Absolutely.
into these
Absolutely.
projects.
Yeah, and that is actually a very good point. Like if you have like good value add, you're levered, you have leverage, you get that, capture that value add, you capture the spread between your cap rate and currently low interest rates, and you do that in a way that is okay. I don't think you're gonna get a price hit. I mean, if you look at in 20th century in the history, like the history of prices, there was 2007 that was a big drop, and then that drop was okay nationwide, was like 20 to 25%, but then even closer to 20%. And then the biggest other drops, they were, I think 13% is the second one. So it's not like so, real estate has done really well in America. So that is something there. Yeah, and markets like Arkansas, a market that is 14% undervalued, it's not gonna go anywhere. When that's the same thing happened in North Dakota, like last cycle. But that said, okay, if a market is overvalued, does it mean it's going to correct? So these are some scenarios. So there are three sort of logical outcomes that can occur. So one is a correction, so the price drops. The second one is, okay, the price continues to grow, but grows very, very little. And then incomes grow healthily, but basically reduce price growth. So it's possible that if a market is overvalued, we have Idaho now overvalued by 22%. That can resolve. They may get less price growth in the future, and at some point, incomes and prices, they catch up, and everything is back to normal. It's also possible that in Idaho, incomes explode. So that's the third scenario. It's possible that, okay, it's overvalued, but incomes are going to do super, super well. And so, the markets becomes fairly valued, even though, at the onset, it was overvalued. Okay. And just one moment, I think it's wrong. Yeah. So in 2007, like I mentioned, was a correction scenario. So out of like 2,700 counties that I have income data for, those basically 93% of overvalued ones corrected. Let's say, and okay, define a correction in a certain way, and then 98% of fairly valued, and then 94% of undervalued. So broadly speaking, it was a correction scenario. So the similar data study, actually, it's not so useful to have it at the state level, right? It doesn't tell you where to invest. So I do it at the county level. So at the county level, their correlation is less. So it's not 83% anymore, it's 73%. It's harder to predict counties. I would say, much harder. But still, again, this is a regression of 2,700 US counties, and you have 73% correlation versus what is the future, or what was the future back in 2007. So that was pretty good. And then some cities. So we saw the overvalued states. So what are like some cities that are currently overvalued? So Boise, Idaho. So expectedly, an Idaho city is the most overvalued, 33% overvalued. It continues being really trendy with investors. I see it on Bigger Pockets, etc. People like to invest there and continue being bullish. And there are many opportunities. The market is growing so well for good reasons, because the economy there is doing really, really well. But again, it's precarious. It's risky to invest there unless you have some better sense of where we stand within the market cycle. So Boise, Las Vegas, Tampa, Austin, Washington, Fort Worth, Phoenix, Nashville are actually overvalued, some well-known overvalued cities. In the second table, these are the most undervalued. So Illinois market has suffered a lot. We have Chicago at minus 27%. Cincinnati, Baltimore, Greensboro, Memphis, Pittsburgh, Louisville, San Francisco are undervalued. San Francisco is always like people ask this because it's this very low affordability. So, but the fact that low affordability is in fact ties to the exact same analysis that is here, because affordability, that's the price income ratio. That's what affordability is. But yet, San Francisco being not affordable does not make it overvalued. It is changes in affordability that drive subsequent drops. And changes in affordability, by the way, and I'm going to mention this later, actually happen for different reasons. They can happen due to housing shortage, for example. And so those cities like San Francisco, they have, over time, they have built up housing shortage. They have reached very high values of, let's say, inaffordability, so to say. Their price income ratios are very high, but they're consistently high. They are not overvalued. So San Francisco is actually undervalued. Okay, then here, this is a very interesting table. So here, this is like to the discussion, undervalued markets that have done well. So we saw previously that Denver, Colorado was the best performing city this market cycle. Denver, Colorado, 79% above its previous peak. And yet, it's fairly valued, it's at 0%. The rest of Colorado is actually overvalued. Most cities there are 15% overvalued. And yet Denver, the best performing city in America, is fairly valued. So that is something interesting. That's why it's important to normalize prices, such as, you know, like as it is done here, because one cannot have an intuition just because a market has done well does not mean it's overvalued. Yeah, so Denver, San Francisco, Pittsburgh, Omaha, Columbus, Indianapolis, Atlanta, Louisville, and Philadelphia, they're strong performing undervalued cities right now. So this is very much a market study. So it's purely data and purely prices. I don't make comments with regards to COVID or suburbanization and shifts from cities to other places. Some of you may have watched Neil Bawa. I watched his latest lecture. It was actually really good. I recommend it on that. This is by Redfin CEO. So Redfin CEO shared this in a lecture, and he shows basically user statistics. So, for example, in New York City, 35% of users are searching elsewhere. So they search to, for homes in other places. So they search in Atlanta, in Philadelphia, in Washington, Miami, etc. So that is something in terms of domestic migration. So just quickly, some demographics to mention. So population in US in recent 2 decades has been growing the most in Nevada, Utah, Arizona, Texas, Idaho, Florida, Colorado. Some of the least growing population has been West Virginia, Michigan, Rhode Island, Illinois, New York, Vermont, and Ohio. So population has 3 components, has natural increase, international, and domestic migration. So domestic migration is something that gets discussed very, very much. So for example, we have the Northeast with negative domestic migration. So we have New York State at -7%. And so overall domestic migration has been weak in Alaska, Northeast, parts of Midwest, Hawaii, Kansas, and New Mexico. It has been strong in the West, except California, Colorado, Texas, Florida, and North and South Carolina. International migration has been sort of the opposite though. So international migration has been strong in the Northeast, Florida, and Hawaii, and has been weak in some low-income US states, West Virginia, Mississippi, Arkansas, Louisiana, Alabama, Wyoming, Montana, and Nevada. So there has been some offsets between domestic and international migration in some places, New York State very notably. Natural increase strong in the West, except Oregon and Montana, Alaska, Southwest to Dakota State, Nebraska, and weak in low-income states, West Virginia, Alabama, Florida, Northeast, and Ohio. So this is where incomes dropped the most in 2007. So the largest drops were in the West, Southwest, and Florida, and smallest in some lower income states, Alaska, and parts of Northeast. So where income has been growing subsequently. So that is interesting. Some of the areas that have low population growth, like California and New York State, for example, incomes have grown very healthily there. So even though population quantities are not good, the quality of population that comes in there is actually good. So that has kept prices to an extent and has kept like good price performance in states like California and New York. Now it hasn't been booming like it has been in Texas and Colorado, but it still has been good. and I am going over time. So cap rates and interest rates relationship is very looked at in commercial real estate. So there is a correlation between the two. So there is, they tend to move together over time. Okay, and let me skip this one. Okay, that is fine. That said, valuations, so price income ratios, have not had the same relationship versus interest rates. So here we can see in blue the valuations of US real estate on average over since 75, and then the negative, sort of negative trend in interest rates. Interest rates have been dropping for 40 years already. So US real estate valuations, price income ratios, I was getting like a tip from an acquaintance of mine who works in commercial real estate as an acquisitions specialist. And he was telling me that actually, okay, I should adjust valuation metrics for interest rates, but that doesn't seem to be the case. So interest rates have been going down and down and down, and valuations have been relatively level. Now, some further studies, like I mentioned, Neil Bawa's recent lecture, so on suburbanization. So what I found most interesting in his lecture was, okay, he looks at the spread in vacancy rates between suburban areas and central business districts. That spread actually has reversed for the first time. So that is material. Suburbanization is not something that people want. People want to live in cities, but it happens because of profit seeking. So it's driven by profit motives, and it's driven by companies who can be more profitable this way. And so that is, I think, the primary driver of that. Now, cap rates to interest rate spread, another thing I didn't show here, is actually very high right now. So that's indicative of a very attractive market, like especially for investors you want to invest in when the spread is really high. So that is a bullish indicator as well. Another thing, price income ratios, and I'm working on an enhanced version of these valuation metrics, actually shift regime as population to housing supply changes. And that is what happened in cities like DC, for example. So in DC, we have like it's very not affordable. It appears overvalued, but in fact, there has been housing shortage, significant one, and that has driven price income ratios higher. So it is not that income can predict drops. It's not sufficient. It is the change in price income ratio inherently reflects other factors in it. Some of these factors are housing supply and population. It has been very predictive because of using a historical average where that value already moves with housing supply and population. And yes, so an even improved version that I'm actually working on is how to better reflect that in a more precise way. So that is also interesting. So with that, thank you so much. I'm over time and really appreciate it. So these are some ways to reach to me. So LinkedIn is good, and my email address as well.
So Stefan, nice presentation, so much of information. I mean, it's like drinking from a fire hose, at least for me. But I would open up for questions, guys, feel free to ask any questions in the chat box, and I'm monitoring the questions. If you have any, feel free to ask any questions. But I mean, to cut to the chase, as an end user for this data analysis, I think what people really want to know, what is going to be the next few cities where they can invest, without the fear of losing their capital. I mean, that's just a fundamental question, I mean, what are the counties, or what are the states, or what are the cities where we can project essentially that there may not be significant drop, So that's the fundamental question everybody wants to ask, I would think.
Absolutely, yeah. And I think there is a big list right now on that. And so like this is the slide that I showed that shows some of the also well-performing cities, that are undervalued. I mean, we had this discussion, like if we use I say Arkansas as an example, prices are not going to drop there. If we use, well, Pittsburgh, Pittsburgh actually, is a market that, gets associated with it's troubled, but actually its pure price performance has been strong this cycle. Has had actually the best in the Northeast. Yeah, it's still undervalued at 8% undervalued. So I would say anything that is more than 5% undervalued from what I see in the data at the state level is purely not going to drop or material. It's going to be like 3-4%, which is nothing. And now at the cities level, if we have something that's undervalued, it's not necessarily going to be so protected because, again, like we have used right now, for instance, the shift from New York City to other places, etc. The city level, it's harder to predict. There are shifts that can happen there. But if the state is undervalued and the city is undervalued, this is my personal approach right now. So I think I would not invest in an undervalued city in an overvalued state. Because I think the city level projection is not so strong. The overvalued state can drag things down for it.
Yeah,
so.
For example, Oklahoma, if you go state-wise, it is undervalued, and Tulsa is also undervalued in Oklahoma.
Absolutely, yeah. So those are markets, I don't expect those to drop much at all.
Yeah, they won't drop, but they won't appreciate. I mean, the chances of appreciation also.
Well, that depends. Now, that some of these markets here, specific cities that have done well, they will do well, continue to do well. So there, it can be like Denver, Colorado, we appreciate it really strongly in spite of, it has been undervalued before. And Texas is an example. Texas was actually undervalued in 2007. That's why Texas didn't drop, and it's it's the best market nowadays. So it's not. Undervalued markets contain some of the weak markets, but there are also strong markets there.
So there's a question, Stefan, what are your top 3 ideas in the public markets based on this work? I mean, the same question which I asked, somebody's asking, actually Saurabh is asking, what are the top 3 ideas that you have looking at your data? I mean,
in the public markets, like in the stock market?
No, I mean, in these in the real estate market, what are the top 3 states/city combinations that are good based on your research?
Okay, for that, I've been working a little bit on a more precise measure for price performance, like I mentioned, based on fair valuation. So it's going to slightly differ from what we have here, to be honest. But I personally, from a purely price standpoint, Pittsburgh looks good. From a purely price standpoint, there are cities in Indiana that look good. And then, yeah, I mean, those are some of my more leading choices, I would say.
I have seen this data before, Stefan, if you don't mind.
Yeah.
You have shared this with me before. I like Arkansas, I like Louisiana.
Arkansas has some very interesting counties. So I think there is a city or a county called Rogers, or like Fayetteville is another one. But there are several counties there that actually are super, super undervalued right now because incomes exploded over there, and they seem to have had good price performance. And so in Arkansas, there's Little Rock, because we were looking at it before. It's the big city, and Little Rock is okay, but some of the other places have had stronger price performance that I would say is strong enough, like over 20% since the previous peak, and they're all undervalued. And like Fayetteville and Rogers, I believe, are heavily, heavily undervalued. They're the most undervalued. The counties that contain them are the most undervalued counties in America, in fact. And so those are good markets to invest in, I think, for sure. Will they see the super, super high price performance in Arkansas? No, the super high price performance will continue to be in Texas and in Florida.
Yeah,
success fee.
of course.
But but again, it's
It's
going
a
to be
risk versus
riskier.
reward. How much risk do you want to take?
Yes, and as the market cycle progresses, it's going to get riskier and riskier to be there. So at
Yeah.
some
So,
point, it's going to be too late.
so I'm going to ask two more questions. Somebody has put in here is, to what extent have local laws been taken into account into this data? For example, New York City has passed even more strict tenant protection laws, limiting rent increases and adding further burdens on landlord. Crime is high and people are leaving retail and services are dying daily. Has this been accounted in your analysis?
No, it has not. So this is
Okay.
purely, yeah, this is a price kind of analysis. The kind of, I would say, the kind of narrative that that is brought like by this question is already baked into, for example, domestic migration statistics. So one thing I want to say like about this kind of like narratives of events happening and then trying to project the future, it's very speculative because we don't know actually, to what extent they affect prices. There are many, many factors. Now, what is retrospectively reflected in the data, it's already there, it's already seen. So people are leaving New York State domestically, and that's a fact. That has been happening for a long time. New York City, that people are afraid now with COVID, people have been living New York City for nearly a decade domestically. It has been kept by international migration, and and so that is different. And there is there's very good quality of people who have come to New York City. But again, I'm bearish on New York City myself because of some of the suburbanization trends that we saw. So I'm definitely bearish on it. I don't know if it's going to be a doomsday scenario, but I think profits are driving that. It's not preference. So it's a suburbanization or like this kind of trends are driven by businesses, I think, not by people.
So do you have any knowledge about REITs, Stefan? I mean, which REITs are
not
best?
so much. I mean, okay, showed like REITs more that I looked at contain now they're all large commercial real estate, multifamily and other sectors. They also typically contain mortgages in them, so that's something to consider. And also they contain, except REZ is the only one that contained only multifamily that I saw, only residential. The other ones, they were all, like offices, industrial, etc., like pretty mixed real estate. So of course, I mean, that's going to have a hit. Now, large multi have a hit according to REZ, what the stock market is telling is going to, yes, it's going to have a drop over the short run in some sense. But over the long run, the spread of interest rates is super attractive. The multifamily cap rates are going to be going down. So that's something, I don't think there is any other direction for cap rates except going down. And that's going to be raising the values of commercial multifamily over the next few years. Now, a correction, I think, some drop is supposed to happen because that's what the stock market, that's what the REITs are saying. So I don't have a selection for REITs. I would invest in REZ that does not have offices, etc. in it. Or let's say that does not have retail in it.
One more question. Somebody's asking, so how can I go long in Arkansas and short somewhere which is overvalued?
Well, how can you go short in real estate is, I mean, that's not a very easy, I mean, you can do that in the stock market, obviously. You can short, well, it would be hard to, I'm not aware of like very original real estate investment trusts. You can look for such. I've looked at just like the main ones in like etfdb.com, places like that. And they are, like they are pretty broad, it seems. It's not like there isn't too much liquidity in real estate investment trusts that are particularly specialized from what I see.
All right, I don't have any other questions, Stefan, and we are on the time right now. I don't know whether anybody has any more questions. Any last questions, guys? Guys, this chat window, as I said, feel free to share basically your information, contact information if you want to network with somebody.
Yep.
Stefan's information is here basically, and my email address is Prashant at myrealitygains. My Realty Gains or Multi-Family Realty Gains, both are my email addresses. Feel free to reach out to Stefan directly or to me. And I sent a link in the chat window for a 7-day email course for passive investors. If anybody's interested, it's a free course. Feel free to click on that. You will get 7-8 emails talking about passive investing, benefits of passive investing, tax advantages, things like that. So feel free to do that. But I appreciate, Stefan, for taking time to talk to everybody. Yeah, no, so very, very good. I mean, I know we have been talking for some time, and this is super helpful. And the recording of this will be available, and I will send it out to everybody within the next couple of days. I mean, it will be on YouTube, or I can send the recording also as soon as I get the link back to me. All right, guys, thank you so much once again. Good night, everybody, and take care. Thank you, Stefan.
Thank you.